Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everybody. Welcome to the 26th episode of Carson's Facts versus Feelings podcast with Ryan and Sonu. We have an extremely special guest today. Sonu, we're not going to say who it is yet. If someone saw the title, they know who the special guest is, but maybe somebody doesn't quite know, so we'll draw up some suspense here. Just how excited are you about today's featured guest?
I've been looking forward to this ever since we planned it out, so it's been several weeks, and I've been a huge fanboy of our guest today, an extra special guest, certainly. So absolutely excited and honored to be here today.
No question. You went to India. I might talk about that a little bit more. You went to India recently, just a couple days ago, to see your sister for her wedding, and you read his book on your way home. So you might even know a little bit more about what he wrote, 30 years ago than he remembers to this day. But with that, we're very proud, Carson's Facts versus Feelings, to welcome Professor Jeremy Siegel as a guest. We are huge fans. But Professor Siegel, let's start off with the question that everybody's asking. Did you really have Princeton in the Sweet 16?
No. I don't think anyone. I mean, it's rare for we're an automatic entry, the Ivy League team. And 90% of the time we lose our first game. And then 90% of the time, if we make that, we lose our second game. So to win two in a row, although I will have to tell you that way back then, probably before you guys were born, but I think it was in the 1970s, Penn made it to the Final Four. They got blown out there, but we did make it there. That was when it was always regional, and the regional head and wasn't mixed. Yeah. We were strong in the region. But it's really rare.
No, it is. I mean, I don't know what's more rare, right? The activity in the bond market, where we've had 7 days in a row of the 2-year moving 30 basis points, first time in history, or like you said, an Ivy League team looking like a potential national champ. But listen, let's just get into it again. We are so honored to have you today, Professor Siegel. I know that was the softball. I gave you a softball. Sonu's going to come in with a little more heat. Sonu, why don't you let's kick off the podcast with some questions for Professor Siegel.
Yeah, I don't want to talk about March Madness because Purdue lost. So
yeah, that's true.
But so stocks for the long run, right? I mean, I have the book next to me. I'm not going to pick it up because last time I did, just before we started recording, I think I banged my mic or something like that. So
it's a heavy book.
It's a
heavy book.
It's a heavy book. A lot of good stuff in it. But Professor, look, you published the book in '92, and we've had so many crises since then, right? You had the Asian crisis, the long-term capital management, tech bubble, the bubble burst, great financial crisis, and then the last decade was European debt crisis, China, then you had COVID, inflation, Fed, all of this stuff, right? But stocks have just continued to move higher and higher over the past 30 years. I mean, close to just about 9.5% annualized return. I was looking at that. So let's start there. Let's talk about, why do stocks continue to do better than every other asset class over the long run?
Well, Sonu, you hit the nail right on the head there. The first edition of Stocks for the Long Run came out in 1994 using data through 1992. And I computed back then that the real rate of return on stocks, that's capital gains plus dividends after inflation from 1802 to 1992 was 6.7% per year. What is the fascinating thing is when I finished this book, 30 more years of data. And guess what the real return on stocks has been in that last 30 years when all those events that you just mentioned have occurred? 6.7% per year after inflation, which is really quite remarkable and shows you the long-term persistence and stability of long-term stock returns.
Oh, it's incredible. And so maybe, I know you just published the 6th edition. So what did you add in there? I think both Ryan and I are definitely curious about crypto here.
Yeah.
So your thoughts on, there are these new asset classes, right? So maybe, talk about, what about crypto? Because I think a lot of young people are probably thinking about, wait, should we get into crypto now? And then there's always a question of things like gold, right? So maybe give us some perspective on that too.
Yeah. Well, first of all, there are 5 new chapters there. I have added crypto to one of the other chapters, which is called Gold, Money, the Fed, and Crypto, adding a whole section on crypto. I've added, really expanded value and growth factor investing. We could get that later. Inflation and stock prices, interest rates and stock prices. So there's been, it's the biggest revision that I have. Crypto, I kind of thought it was like the millennials' gold. When I knew that inflation was going to, hit after the COVID crisis, I was first recommending gold, but I saw right away that, that wasn't the attraction like it was in the 1970s. It was really crypto. Now, crypto got way too high and suffered a lot of drops. I'm not what I call a crypto fan, but I'm not a crypto skeptic. I'm neutral on it.
So let me jump in. You're not Charlie Munger. You're not Charlie Munger.
No, I'm not Charlie Munger who thinks it's like the world's greatest scam out there. Because I really think that there are, as we can see, there are problems with our banking system. There's problems with what we call a fiat money system, which the world is basically on. That has a tendency towards inflation, that has some instabilities. I mean, clearly, the run-up since the banking crisis of SVB, less than 2 weeks ago, as we're recording this, is really fueled by, I mean, it's telling the story of crypto. I mean, that's the story they were telling. Don't think you can trust the banks. And I think they've been, everyone over 250,000 insured and all that. They said, hey, I might as well now go into crypto on that. And that's what I think fueled the big rise. Crypto still has not proven itself as an effective medium of exchange. I know that, 2 or 3 years ago, we all thought we were going to walk into Starbucks and buy our lattes with crypto. That has not happened. And even, certain countries, I believe it was El Salvador, that was going to adopt it as an official currency. It has not really worked out well. So it's got a long way to go. What it is good at, international exchange. Not exchange in the sense of, when we travel and use visas, but I'm talking about immigrants and people who want to sell $30, $50, $100, $200, $400 by Bitcoin. It's in a very effective way instead of the very cumbersome international money system, which charges a lot of these people 10, 15%, which is outrageous. So there are efficiencies. Again, it hasn't reached money status, but banks have to become more efficient if they want to keep their monopoly on mediums of exchange.
Really interesting. One thing that just came up, you mentioned your first edition was in 1994. Again, thinking about different people that listen to this, I'd like to see, in your opinion, what's changed since 94? I guess just thinking, to me, 2 things that I've got, just how connected we are. Right. I mean, the 16th largest bank was just taken down because a bunch of guys were on WeChat all at the same time. I mean, that's the truth. Right. And the other one is the Fed. Back in 94, you didn't even know when the Fed was hiking or cutting. You had to find out later. You may not know exactly how it worked. But now we all know when the Fed meeting is, and we're looking forward to it every 6 weeks, or maybe we're not looking forward to it every 6 weeks. Those are 2 things that have changed. I mean, you want to add on those, or what else is new in the world of investments since 94, since you wrote your first edition to your book?
Well, certainly I think ETFs. There was none back then.
Yeah.
I mean, I forget when the Spider first came out, but maybe it was 20 years ago, 25. But I think and electronic. I mean, the Florida New York Stock Exchange used to handle 90%. Now it handles 10%, if that. It's all everything is electronic. The disappearance of commissions, of course. You're indirectly paying for it by bid-ask spreads, but even they have collapsed from what it used to be. I mean, back when I was younger, it was, they used to trade an eighth of a point and that was the minimum bid-ask spread. Now, it's a penny or 2 pennies, and commissions were set by the New York Stock Exchange and could not be changed. That was eventually abolished in the late 60s. I mean, so there's huge changes, and as you said, the lightning speed by which information flows that could cause a bank run, like on Silicon Valley Bank, or of course the communication that caused the Reddit crowd, the short squeezes, the meme stock. None of that was in existence back then. But the basic principles of investing, and as I said, the real return on stock being the best of all major asset classes, has still persisted.
And so on that, and so real returns basically returns, nominal returns minus inflation. So let's talk about inflation and the Fed, Professor Siegel. You were well ahead of the Fed in this is mid to late 2021, saying the Fed needs to raise rates. They didn't. Now, eventually they caught up. And are they going too far now? What are your thoughts on that?
Yeah, I think they are. I mean, you're absolutely. I was, being schooled in monetary theory and policy, as I was at MIT, and then teaching at the University of Chicago for 4 years, with my colleague being Milton Friedman. The last 4 years before he retired, I really understood how money causes inflation. And when we bursted money after COVID, I knew that inflation was going to be rapid and come in a year. And all this talk about transient, I thought was garbage. And I said so from day one, that it was. But then when I saw they clamped down on the money supply so much that actually in 2022, might be interesting you to know that we actually had the biggest decline in the money supply since the Great Depression of the 30s, I began worry. And I said, listen, they've got to go softer. They're going to cause another crisis on the other side. I'm not saying this is not going to be turning into Lehman or anything like that, but I think they went up too fast. They ignored the effects on the banking system, raising the probability of a recession, which I don't think was necessary. We were slowing inflation. Inflation has slowed dramatically.
So I'll jump in there, Professor Siegel. By the way, 26th episode, Carson's Facts versus Feelings with Professor Jeremy Siegel. So we are recording this before the Fed meeting. So by the time someone's listening to this, there's a good chance the Fed meeting have already happened. What do you think they should do? But what do you think they're going to do? Putting you on the hot seat a little bit here, but what's your take here on what they're up to here?
Yeah. Oh, I put you in a hot seat. I think they're going to go a quarter. Although there might be dissents and there may be some that still want 50 and want to ignore all this. I don't know. There might be dissents. We haven't had a dissent in over a year here on the Fed. I've actually criticized the groupthink of the Fed, but I think they're going to go a quarter, but with much more modest guidance. We're going to get the dot plots, and it depends on when these bank presidents turned in their projections. Was it before SVB or after, and how much after? Yeah. But I think what Powell says in the press conference that will follow the meeting is going to be really critical. If he might say we raised 25, but we can afford a pause right now, and see how things shake out, or we can he'll never commit it. But he could suggest that we might pause given the data, claiming we have made progress on inflation. So I think the words, and not so much the dot plots, but the words of Powell in the press conference that follow are going to be very critical for setting the tone of the central bank in the markets going forward.
Yeah, it seems like the March meeting is going to be so important in so many ways. And so one thing is, you mentioned the dot plot, and that's where, Fed officials give their estimate of where they think, quote unquote, appropriate policy will be and what will happen to the economy under appropriate policy. So including the unemployment rate, right? So now they predicted that they or forecast, however we read it, that the unemployment rate will go up. It's almost like they want to see that. So I'm curious your thoughts about, how does the Fed see that connection between the labor market and inflation? And, your thoughts on, are they even right to see it this way?
Well, it's interesting because Powell testified before COVID, I think it was 2019, that, the Phillips curve, which is that classic trade-off between inflation and unemployment, we've shown it's kind of dead. We're not following it that anymore. In fact, the new Fed policy that came out just before COVID really didn't, said we're not going to be looking at that tightness in the labor market. Well, all of a sudden, he seems to have gone back to that as being a prime determinant. I've been a big critic of him trying to get wages down. We have a structural labor shortage in the U.S. Caused by a number of factors. First of all, we need more. We need reform on immigration and more immigration, but also the changes that are brought about with all of the mass retirements that during the COVID crisis. A structural shift. That's words of Chairman Powell. And if you have a structural shift downward of labor supply, you must have an increase in labor wages to induce people into the markets. So, it seems to me a wrong policy of Chairman Powell to try to beat down wages when, in fact, we need wages to rise so that people can fill slots that remain empty. Now, in the last labor market report, we've gotten a little relief. Unemployment rate rose 0.2%. We've seen a little less tightness in the market, but it is still a tight labor market. But my feeling is the Fed, yes, we'll have a couple more points of inflation on the service side, but we'll be a much healthier economy, and we don't need to put 2 million people out of work, cure the inflation problem, which frankly the Fed itself created by overexpanding in 2000 and 2021.
So you mentioned the economy. Let's go that route. What do you think about the chances of a recession? I'll just say this. This morning, that Bank of America Global Fund Manager Survey came out, big jump in people expecting a potential recession over the next 12 months. We all go on TV and talk about it, and we see a lot of bearishness out there. Do you think we're going to go into recession over the next 12 months?
Well, I think it went up, certainly in this banking crisis. I think it's 50-50. It depends exactly how, we define it. We had last year 2 quarters of negative GDP growth, which is a technical definition of recession, but the NBER did not call it because we had such strong employment. So it's, exactly what do we mean by recession? Do we mean 2 quarters of negative GDP growth, or do we mean that the unemployment rate has to go up to some amount? The NBER itself does not have a hard and fast rule. It looks at 4 or 5 different data sets and makes a judgment, often, by the way, months later afterwards. So we're not going to get a call suddenly we're in a recession. I think my feeling is, again, if the loosens up now, we have a chance of avoiding that recession. And I believe and still bring inflation down to reasonable levels. I don't think we need a sledgehammer now, everything to cure the inflation. Milton Friedman himself said it would take 12 to 18 months before monetary policy really had effect on inflation. And believe it or not, it was exactly a year ago this week when we had the first hike. It's hard to believe. We were at 0 Fed funds, and now it was the first hike on Fed funds a year ago on this meeting. To expect in a year that we solve the problem is unrealistic, and has always been unrealistic.
Sure.
So my feeling is that we got to. I would say pause now, start lowering rates. I see no inflation in the sensitive commodity indexes.
Wow. Yeah.
Interesting. So, well, so tying inflation to this banking crisis, right, or crisis, you mentioned that you don't think it's, anything similar to what we saw in 2008 with Lehman and AIG and all of that. But do you think credit creation will slow as a result of what's happening, especially on the
Yeah, well,
smaller
I
banks?
think anything. Look at credit creation is caused by a lot of loans. I mean, banks create loans and then they give you a
Right.
deposit. That's how a lot of deposit
Hmm.
creation. That's how M2 gets created, the most important money supply
Hmm.
definition. I mean, but what's been happening is a lot of banks are looking over their shoulder and say, it's a questionable loan. They may not give it anymore because
Right.
what will the regulators say? They may come in and say, well, this guy didn't deserve a loan. So it puts a chill. It's almost like raising the Fed funds rate. And so you're not scared away by the price, but you're scared away by the lending standards suddenly jumping up, which is a de facto tightening. So, what we saw with SVB Bank, I think is like 2 or 3 25 basis point increases in Fed funds rates. And that's why, my recommendation would be that they take it really easy right now until we can get the economy back in its foot. Nonetheless, I think that a 25 basis point hike with a pause implied is a likely output. Again, there's a lot of uncertainty, but as I stand here the day before the meeting, that's the landscape I see.
Yeah, I think a lot of people are calling that a dovish hike, right? Potentially a 25 basis points with that dovish look. Staying on the theme of the banking crisis and what's going on, FDIC insurance, right up to $250,000. You see, it's become political, like so many things do. People say we should just backstop everything, but you need Congress to get involved. And I guess they're trying to find some back loops to maybe go avoid Congress to do this. What's your take, Professor Siegel, on FDIC insurance and how much should it go up? Should it go up? What do you think?
Well, I think it should. I mean, it's never been indexed to inflation, and it was, set at 250,000, 15 years ago. I mean, and I think, I think we should basically have 1 million. And I think that payroll accounts should always be insured so that people get paid. It's silly for banks to, if you have $100 million payroll, a big corporation, does it have to spread it again around 1,000 banks? That's very costly and inefficient. I think payroll accounts should be insured. I think we should go up to 1 million. And I think that in a crisis where there's a feeling about a run being a problem, they should have the ability to insure temporarily until they can sort it out. And if you've been given a loan fraudulently, suppose I go in and I know that, there's a fraudulent conveyance of let's say a $10 million loan. They give me a $10 million deposit. The banks should be able to claw that back on examination so that the taxpayer doesn't, get tapped for that. So I think they should examine deposit. But most of the people who have deposits, it's their own money. It's not that they got the loan from it. But a lot of businesses, a lot of corporations, they have what's called compensating balances at the bank. That's required. As long as they get that loan legally and it was done right, it's wrong, I think, to have them worry about the safety of their deposit.
It seems like just this morning, I saw on the tape that Treasury is thinking about insuring all deposits, albeit temporarily. So do you think that's enough then?
Yeah, I think that is enough until we reform the system. Because, you just, any even pure 100% solvent bank that's given the greatest loans cannot stand if everyone wants to take their deposit out. I mean, a bank transforms liquid deposits into loans. It has to have capital, it has to have cushion so that, if they've made bad loans, it's not taken from the taxpayer. And the truth of the matter is, if we look back at the FDIC, it has taken very little, if anything, from the taxpayer because it's made money generally. So we haven't been in a situation, even, we insured deposits during the financial crisis, much worse than what we have now. and the Fed actually made money on them on the loans that it actually gave to the banks, and the FDIC itself, to my knowledge, did not lose any money. So it's really important for the stability of the financial system, preventing people from suddenly making a run on the banks. Any even solvent bank will fail under those circumstances.
Very, very interesting. I will say we talked about Purdue, we talked about Princeton. I went to Xavier University. If you're watching on the YouTube channel,
and you have the pen,
Xavier
don't
pen.
you?
I've got my X pen here, so Sweet 16 Xavier. So go Xavier. Professor Siegel, this has been awesome. We have less than 10 minutes. It's amazing how quickly these go. So only a couple more questions. Let's take a broader. This is great macro view, Fed, inflation. Let's just kind of do a timeless question here for the listeners. What's one of the biggest mistakes you've seen investors tend to make, time and time again? And maybe one way they can rewire their brain not to make that mistake. But what mistakes have you seen over your career?
Trying to time the market. I mean, I know a lot of people that have totally bought into the indexation and broad-based, and yet they still do badly because they try to time the market. They get scared at the bottom. They get over bullish at the top. As a result, you take money out when it's at the bottom. You put more money in at the top. And even if you're purely indexed, you're going to underperform the S&P or whatever your index is dramatically as a result of trying to time the market. Now, I always recommend, if you love the market, you have a certain amount in funds, don't 10%, 15% you can play with, trying to pick winners. If you like to do that, have fun, but not with the bulk of your, savings.
Got it. On that, speaking of timing, how do you think about valuation then? Overvaluation and undervaluation, and even bubbles in general, where, it's, I think, easy to recognize bubbles in hindsight, but, in real time, how do you think about that and try to...
Well, I look at price earnings ratios of the market.
Okay.
Yeah, I mean, let's look at the price earnings ratio. Right now, it's selling 17 times this year. That's very reasonable.
Okay.
If you take the times when we've had interest rates on treasuries of 12, 13, 14% and all that, you have an average of 18 or 19 on PE ratios. So we are not bought. A lot of people say it's still too high. I mean, even if we have a recession, remember, and I think if we have one, it's going to be mild. It's only 1 year of depressed earnings. And I think 2024, in fact, in a way, this banking crisis might be a blessing in surprise to get some sense in the Jay Powell and saying, I can't go much further. I have to think of reducing it. If we didn't get a crisis, he would be on his way to 6% and more. And then if we had a crisis, it would be much worse. If we can start pausing and lowering it now, that'll make the recession, if we have one, and I'm not, I'm saying it's close, and it will lead to a much better 2024. I am more optimistic about 2024 now than I was just 2 weeks ago.
That's such a great glass half full look, considering what we've been through the last 2 weeks. But I think that's the general theme, and stocks for the long run. It's optimistic. I mean, I talked to Ryan, who's fantastic at this stuff. I mean, Ryan, you're on TV all the time. I think your take is always glass half full as well. But on the other side, pessimism also sells, right? I mean, how do you look at, because you look at TV all the time and you say pessimist, right?
Well, you are so right. When I remember when I was first thinking of, putting stocks for a long run, and the first edition, I went around to publishers, and one publisher said, that bearishness and crisis mongering and apocalyptic type of predictions outsell optimism 3-1, 4-1 in the market. And I said, yeah, but I'm going to tell what I see there. And yeah, people love to, they love to buy the book about, oh God, the end of the world and all that. And all of us are wearing rose-colored glasses. I would say 6.7% after inflation per year for 30 years and 100 years and 200 years, I think proves those skeptics wrong.
The proof's in the pudding, so to speak. Yeah.
Absolutely. So, Professor Siegel, I mean, this has been a great honor. Where can people find your work more? Obviously, you're on CNBC. You do amazing work with Wharton. You do a lot with Wisdom Tree. Where can we find more of what you're up to?
Well, yes, and and the book is available, of course, on Amazon at a fairly decent price. Stocks are Long Run, 6th edition. And I also am an advisor to Wisdom Tree. And if you go onto their website, register, I do put out a weekly commentary on that. And so I comment around noontime on Fridays. And they can access my commentary.
That's great. And Wisdom Tree has been a fantastic partner to us here at Carson as well. And, shout out to Jeremy Schwartz as well. And,
he is actually one of my with co-authors. He's been, my right-hand man for 30 years. He's worked on 4 editions of the book, including Future for Investors, another book. And I certainly wanted to give him credit where credit was due on the 6th edition.
Shameless plug. Sonu, I didn't even tell you this yet. This coming Monday, whatever the date is, next Monday at 5 o'clock, Sonu and I are going to do a Twitter Spaces with Jeremy Schwartz and the Wisdom Tree gang. So, Sonu, I was going to let you know that. So, anyway,
I didn't know that.
We'll be sharing that on Twitter. So, follow me or Sonu. And 5 o'clock Eastern time this Monday for an hour, Sonu. Surprise, surprise. I said yes. I committed you to it. I hope it works. We're gonna do a Twitter Spaces with those guys. There we go. Well, Sonu, we've got only a couple minutes, but you have one more question, then I'll kind of wrap things up.
Professor, are you retired now officially?
Okay, I am retired from active teaching. I did that a year and a half ago. I was 45 years as a full professor at the Wharton School, 4 years before that at University of Chicago. So I have 49 years, almost 10,000 students, if you can believe that. And I loved my classes, but I felt I'm going to leave it over to some of the younger guys there. As you know, I'm still extremely busy. I'm still writing, and I'm still, on CNBC and other networks, trying to educate and give what information I can to help people invest in the best way.
No, we're glad you're not retired from giving perspective and commentary.
Oh, absolutely. I think just the past 30 minutes, the wisdom and the knowledge that you've shared with the Facts versus Feelings podcast, and it's just been amazing. So, Professor Siegel, from everyone at Carson Group, from Sonu and myself, this was an amazing podcast. We really enjoyed it, and thank you again to the partnership with Wisdom Tree. It's a great teamwork that we have with Wisdom Tree, and just the fact that you could come on our podcast, we are thrilled and honored. And, okay, put you on the spot one more time. Who do you think is going to win the NCAA tournament, Professor Siegel? Then we'll sign off.
I really don't have a clue on that.
You were so confident in everything else I asked you.
There are 2 remaining 1 seeds in there. But given what's happened to the 1 seed so far, I would burn myself. I think you, Ryan, and you, Sonu, probably would give a better prediction than I.
Well, Sonu said Purdue last week, so he doesn't count. I said UConn. I'm sticking with UConn. So we'll see. But that is the 26th episode of Carson's Facts versus Feelings with Ryan and Sonu, and very special guest Professor Jeremy Siegel. So everybody, we'll see you next week. Thanks again for listening. Take care. Bye-bye.